For the 10th month running, Hungary's central bank has reduced its main interest rate by 0.25%. It's now at 4.5%, down from 7%, with further cuts expected. The government is taking advantage of record low inflation to reinvigorate the economy, which remains weak despite being one of the very few European countries to achieve growth in the first 3 months of this year. After a recession last year, the government is predicting growth for the whole year of 0.7%. Inflation is set to be just above the central bank's 3% target, having hit 6.6% last September. The deficit is forecast to be just 2.7% of GDP. The European Commission, though, is not so optimistic either for growth or deficit reduction, and is not convinced that Prime Minister Viktor Orban's government can keep the budget deficit below the 3% EU limit. The country is currently being monitored under the so-called excessive deficit procedure, which Orban has called unjust. As well as cutting interest rates to promote growth, Hungary's central bank is about to launch a programme to help small firms. The Funding for Growth plan will allocate the equivalent of €1.7 billion in zero-interest funding to commercial banks in order to boost corporate lending.